All right, so when it comes to big business, the headlines don't always tell the whole story, right? Well, today we're diving into a Japanese corporate giant that just dropped some absolutely staggering, record-breaking profit numbers. But the real story here, it's not the number itself. It's what's hiding just beneath the surface. The company is Itochu Corporation. Now, if you're not involved in global trade or finance, you might not have heard of them, but trust me, they are enormous. They're what's known as a Sogo Shosha, a general trading company. And their hands are in pretty much everything. We're talking textiles, machinery, food, you name it. And these guys just announced their first quarter results, which, on the surface, look absolutely incredible. We're talking record-breaking figures that grabbed a lot of headlines. But like I said, the story behind the number is way more interesting than the number itself. So first up, let's look at the headline story. What was that big shiny number that got everyone's attention? Here it is, 283.9 billion yen in net profit for just the first quarter. To put that in perspective, that's roughly 1.8 billion US dollars in just 3 months. That's a huge figure for any company on the planet. And this wasn't just a good quarter, it was a fantastic one. A 37% jump from the same time last year, and it set a brand new all-time record for the company's first quarter performance. Okay, but this is where it gets really interesting, because when you peel back that first layer, these amazing results actually reveal a puzzle. It's a perfect example of why you can't always just trust the headline. So here is the crucial point. While their total net profit skyrocketed, the money they made from their actual day-to-day business operations, that number actually fell. So wait a minute, how is that even possible? How do you post a record profit when your core business is making less money? To figure this out, we need to understand a key term that Itochu uses: basic earnings. In Japanese, it's kisoshueki. Basically, this is the profit from their fundamental day-to-day business. It specifically excludes any special one-time financial stuff. This chart just makes the puzzle so clear. Just look at that gap. The headline net profit is way up here, over 283 billion yen. But their basic earnings, that's way down here at 181 billion. That's a difference of more than 100 billion yen. So where on earth did that extra money come from? And here's our answer. That record profit wasn't fueled by their core operations at all. It came from a massive one-time gain of over 103 billion yen that they got from selling off some major assets. And Itochu's own report tells us exactly where that cash came from. The biggest chunk by far was from selling their stake in CP Pokepant, which is a big animal feed business. That one sale brought in 88 billion yen in profit. You add in the sale of an oil company and part of an aerospace firm, and boom, you've completely explained that 100 billion yen gap. Okay, so now that we've solved the mystery of the huge headline profit, we can get to the real story, the core business. If we set that one-time gain aside, how did Itochu's different divisions actually do? This table really tells the tale. And as you can see, it was a total mixed bag. The consumer-focused businesses, things like food and textiles, they did pretty well. But the heavy industry sectors, especially metals, they ran into some major headwinds. Let's break down the winners and losers. So on the winning team, we have the 8th Company, which is mostly their giant convenience store chain, Family Mart. Their profits jumped by a healthy 35 billion yen. The food division also had a great quarter, adding 28 billion yen in earnings, thanks to well-known brands like Dole. But man, the other side of that story is pretty stark. The metals division got hammered by falling commodity prices, and its earnings just plummeted by a staggering 189 billion yen. The housing division also took a 61 billion yen hit thanks to a pretty tough real estate market. So this quarter, fueled by selling off assets, left Itochu sitting on a huge pile of cash. And that brings up a really critical question. What does a company actually do with a massive windfall like that? It's a fundamental choice that every management team has to make. Do you reinvest that cash to build the company for the future? Or do you reward the people who own the company right now, the shareholders? Well, Itochu's actions this quarter show that they are focused very heavily on one side of this equation, rewarding their shareholders. And they've made two huge commitments to prove it. First, they've guaranteed an annual dividend of 200 yen per share. That is a straight-up cash payment to every single person who owns their stock. It's a really clear way to share the wealth. Second, and this one is even bigger, is a massive 150 billion yen share buyback program. So by buying its own stock off the market, Itochu reduces the total number of shares out there, which usually helps boost the stock price for all the remaining investors. It's a huge return of capital. Okay, so let's zoom all the way out. What do these results, the big asset sales, the struggling core divisions, the huge rewards for shareholders, what does all that tell us about Itochu's big picture strategy for a pretty uncertain world? Itochu's own analysis points to some major risks on the horizon. We're talking geopolitical instability, a potential global economic slowdown, and of course, mounting pressure for decarbonization. This is the stormy environment they're trying to navigate. And this slide basically lays out their three-step plan. Step 1 is asset rotation. That means selling businesses like CP Pokepon to unlock cash. Step 2 is using that cash for shareholder returns, which are the huge buybacks and dividends we just saw. And step 3 is making very targeted investments in new areas they think will grow. It's a clear plan. Sell what's risky, reward your owners, and invest very carefully. But this leaves us with one final and, I think, crucial question. These big one-time gains look fantastic on paper, and they fund some very generous rewards for shareholders. But with their core businesses facing some really serious headwinds, can a strategy that relies on these huge one-off sales actually create sustainable long-term value? That is the multi-billion-dollar question that Itochu is facing right now. Thanks for joining me.